Hey, Kyle. I appreciate you taking time to be on the show. Our hope is to make life insurance as simple as possible. And there's a lot of jargon, there's a lot of channels out there, there's a lot of people that are sharing their perspective. It's always fun to talk to someone that's not in our space, not in our industry, not selling insurance, but is an owner of this asset and that has a great insights to share. You reached out to me, I think it was after I did a conversation with Garrett Gunderson and shared a
Yep.
little bit of your story. And I asked you, would you be willing to come on and share your perspective and your story around life insurance? And you said absolutely. And so here we have it. I've never heard your story yet, and so I'm excited to learn from you. And also just thank you for everyone listening. We always love hearing different perspectives, and I think you'll be able to share some insights that will help someone, whether they're on the fence or someone that has purchased life insurance, and you might help them like really think differently and even like verify like what they're doing or just give them another perspective on how to think about life insurance. So without further ado, welcome. And I would love to just hear a little bit about yourself before we dive into the exciting topic of insurance.
Yeah, I appreciate it. Your channel, the Better Wealth channel, and the team, the And Asset team. It's been an amazing educational asset for someone who wasn't historically familiar with not just insurance, but like all the different nuances of insurance products that exist and how that fit into a financial plan. I'm 36. I grew up in a rural part of Eastern North Carolina. Studied engineering in school. Did that for 10 months. Absolutely hated it. I work in cybersecurity consulting now, coaching executives on how to get business value out of the software that they're buying for their cybersecurity programs. I first came or kind of like started hearing about whole life insurance was from Garrett Gunderson. It was from What the Rockefellers Would Do, the book I think he published in, was it 2015 or 2016? It might have been the first time that I had really heard like whole life at that time. I probably had heard about it before, like term versus whole, and then you typically go down the route of like, well, whole, you're just wasting a bunch of money. Just focused on term, invest the difference, which I think everybody kind of, especially in the financial space, uses that. But yeah, I initially started hearing it in 2016, but didn't pull the trigger on a whole life policy until 2022. So, for anybody who can do math, there was a 6-year gap between hearing about a product and pulling the trigger on that product. And I think some of that is just kind of understanding how the whole life product can fit in your financial plan. I think that's partly the confusing aspect of it, because a lot of folks, if they're like me, I got really interested in investing in 2014, 2015, kind of came in through investing through the value landscape, Charlie Munger, Buffett, Ben Graham, really looking at businesses, looking at stocks as businesses, not as just tickers on a screen. And when you start going through some of their stories, you start hearing about companies they invested in. Then you start hearing that at different points in times, Buffett and some of these investors started investing in banks and these insurance financial services institutions. Well, then you start coming across content that starts talking about how you can be your own bank, and you start hearing infinite banking concepts. And from an investor's lens, you come into whole life from a mentality of like, oh, there's an investing lens or aspect to this, which I think is where like some of the confusion and the gap really comes into. I think the infinite banking concepts, which is what I was initially introduced to, works very, very well and might make a ton of sense, because where I got stuck is the philosophy and the strategy around that approach is very good for existing business owners, particularly like real estate investors. But that's not the largest subset of the population. Most of the population is going to be W-2 employees that don't really have a need for like some type of collateral asset to lean against. So then you're trying to figure out, well, if it's being pitched as this like bank yourself, well, I'm not a business owner, so what am I banking? Like what is this thing I'm supposed to, I don't want to go out and buy a piece of property. I'm not trying to become a real estate investor. I'm not necessarily trying to go buy a business or looking for capital projects to deploy to expand my business, because I'm not a business owner, right? So then you kind of get in this place where you're like, wow, this sounds really great if you fit into a business owner bucket, but I didn't fit into that bucket. So then I kind of put the idea on a shelf and let it sit for a while. It wasn't until I had kids that I saw another lens through it. But I think some of it too was doing the work, like the really hard work of, and I mean hundreds of hours of watching content from you guys at Better Wealth, watching content from guys like Steve Parisi over at IBC Global, doing a ton of work and understanding like how these products can be leveraged in a broader financial plan. That I finally started to understand how this could fit into like a traditional financial planning model, but primarily as a substitute for cash versus a substitute for investment vehicles, if that makes sense. So yeah, that's kind of the short, long summary of my like initial foray into whole life, how I came to owning a policy. But it was a multi-year journey of learning to try to like reverse engineer this product that primarily is marketed as a banking product for business owners. How can like the average person use this in a financial plan, right? Because average folks are talking to financial advisors who are telling them buy term, invest the difference. And there's like, it's completely binary. There's no black and white, or it's all black and white. There's no gray middle area of how there can be some nuance to this product. So that's kind of the short and sweet of that journey.
I wrote something down when you wrote, we're talking about the difference between someone who's W-2 versus, self-employed. I think there is something attractive when you're an entrepreneur or like a real estate investor, like you see the purpose of access to capital and you always are calculating with that access to capital. Whereas you're totally right. If someone's W-2, that might not necessarily be a mental framework that they're always thinking. What was it in 2022 that was like the light bulb moment? Or was it a combination of things? Or like what was the sticking point that you didn't do anything until 2022? I'm just wondering like what that was.
Yeah.
And then what the epiphany was for you.
2022 was the year we had our first child. And like most, well, I wouldn't say like most parents, but like most people this is how I would hope most parents would think. I start thinking, and this gets into like, people have asked like what it was like having kids, right? And what I try to explain to folks is like when you're just married, you can think 50 months into the future. The moment you have your first kid, you start thinking 50 years into the future. Like your time scales completely change. And like probably like most folks who have kids, they're starting to think about like, all right, so now I've got like, this is my lineage, right? My progeny, this is the next generation of my line. So you start thinking like, okay, estate planning, how would I think about transferring assets? I want to imbue them with the character and life values that I have. Like I want them to carry that on, but what if they choose not to carry on those life values? Do I want to transfer assets? And so you start planning and start thinking about all that. I think what I realized with Whole Life as I got into it is, sure, you can set up 529s, you can set up Roth IRAs if you have like a side hustle or a business and, you can classify your child as an employee. You can set up UTMAs, regular brokerage accounts. The thing that I liked about a whole life policy as part of that strategy, as just kind of a leg of that stool for transferring assets to a child, is with whole life policies, there's three individuals that are a part of that. There's the insured, which is my daughter, so she is the insured person. There's the beneficiary, which is me. So I retain some control if something happens to her. I don't want that, but I retain some control. But the biggest part of it is I'm the policy owner, which means that I control what happens to those assets versus a brokerage account, a UTMA, a Roth account. All of the ownership decisions of that transfer to her, whether I like it or not, when she turns 16 or 18 or 21, regardless of what her maturity level is, which, depending on how much you put away for a child, can be very dangerous. I mean, imagine, I think back to when I was 16, and if, I don't know, 25 grand, 50 grand just appeared in my control, I don't know if I would make the same decisions with that back then as I would today. The thing I like about the whole life policies is it gives me a way to do several things. I have control over the finances. but they're finances that at some point in the future, when she proves her maturity and her ability to make sound financial decisions, I can transfer access to that cash value to her. The policy is on her life, which means that while I'm 30, let's see, so when I was 33, I basically was setting up a financial instrument that was going to pay my children's children an inheritance. Yep. So I got to take care of my grandchildren while setting up a financial vehicle that my daughter could take advantage of in the medium to long term. But it was also a financial vehicle that, because I own the policy, I right now own the cash value, I can take advantage of in the short term. So you have a financial instrument that is benefiting 3 generations of people all at the same time. I can't do that with a brokerage, with a regular savings account, with a 529. And I think it was that multi-generational kind of like, I've described it as time travel. It's really weird, but it's like you have a financial instrument that is affecting 3 generations of people all at different times in space that other vehicles can't do. And it's that facet of it that is really really interesting. Sure, I get it. A financial advisor would probably say, yeah, but you're sacrificing, potential market returns. And I'm like, yes, if you compare it to, a market investment, that's not the goal. Like, honestly, if you're going to compare this to anything, it should be a bond proxy, right? Like, just view it purely as a bond proxy, because that's what these insurance companies are investing in, is bonds. It's corporate bonds. It's sure, maybe it's a little bit of equity, but most of it is a bond proxy kind of view. So that was really the change, man. It was for the first time I saw that it was a vehicle that I could retain a ton of control over, but it could provide financial inheritance transfer for not just for my daughter with the cash value, but for my daughter's potential children in the future with the death benefit.
It's cool. And did you get life insurance on yourself at that time as well?
I did not. We got the first policy on her. Obviously, we went through the illustrations. We built out effectively a policy with Guardian that was where we could do the 1090 split. We would overfund this with PUAs for like the first 5-6 years. We got our second policy for our son in 2023, and it wasn't until last year that I got a policy on myself, and it's because the performance of my daughter's policy is now outperforming the illustrations that we were first shown in 2022. Wow. So the policy that I took out on myself was, we're a single W-2 household, and so therefore we have a fairly large savings emergency fund set aside, 12, 15, 18 months worth of living expenses set aside. And my thought was like, well, look, if this is just sitting here, my number one responsibility if I ever have to touch my emergency fund is to replenish it the moment I can, right? Like, if you ever have to touch your emergency fund, the moment you can replenish it, that's the first priority, is to replenish it. Well, I was like, look, if we're going to do this, we might as well add some additional alpha to it and add an estate planning component by starting to move our emergency fund into a whole life policy. So we started that journey last year. So over the next 5-6 years, we're going to start moving large portions of our emergency fund to fund a whole life policy. That's going to act as kind of our secondary emergency fund. But even now, it's already, with the other 2 policies, we're starting to see opportunities where like we can use our whole life policies to self-finance our next car purchase rather than going through traditional auto lenders, if the interest rates and that type of thing make sense. Because I think we did that. We had an auto loan with another lender for our existing car, and we realized that there were 2 things. We could actually pay a lower interest by taking out a whole life loan to pay off the existing loan. But not only that, because of and a lot of people don't realize how loans are amortized, because it's simple interest over the course of a year and then it compounds. We're going to end up saving $1,000 to $1,500 in interest just by kind of banking ourselves on that auto loan. So so policy for us right now is just primarily going to be emergency fund. But at some point in the future, that'll grow to a place where it could potentially allow us to bank a potential business opportunity if we see one that we want to pursue. For right now, it's a nice bond proxy emergency fund to add some alpha there.
I was gonna essentially say, you said bond proxy emergency fund with built-in leverage slash
Yep.
legacy. Was the chronic illness riders at all been like attractive to you? You're like, oh, like I could also potentially have like a long-term care-esque thing. Did that matter at all? And then the death benefit to replace your earning potential, did that have any benefit to you making the decision, or I'm assuming you had term insurance that you felt comfortable enough?
Yeah, I think and it's it's kind of the golden handcuffs of a W-2, right? It's like a lot of times those types of products are provided for as part of a W-2 relationship. So they didn't play a big role in that decision-making process. I already have a term policy that more than covers what my family would need, where they could purely live off of dividend interest if something happened to me. This just kind of became icing on the cake. There might be a need for that in the future where I would be more inclined, and that would be more of an attractive part of that, but it wasn't in this initial decision-making process. And I think some of that is, purely based on like the assets we have outside of whole life policies and what we've been able to build through markets and just investing decisions. Just this part of our financial plan really just kind of takes care of like the cash that we have sitting on the sideline, kind of our war chest that is just sitting there, and it's like, how can we squeeze more alpha out of this without it adding additional risk, if that makes sense? Because even with interest rates, like I know interest rates are higher than they have been, but they're still coming down. Like they're not as high as they were a year ago,
Yep.
So, and you can speculate
and
on
you say
what.
alpha. You say alpha, which is great, but you also like you mentioned before we started recording this concept of like benefits, multi-use deal, and it's tough because you can't really put a rate of return on this. But when you start factoring in all the benefits that you have because you have life insurance as a part of your portfolio versus not, a lot of those benefits start adding up, and it blows any bond or any high yield savings account out of the water when you start factoring in what do other benefits that bonds or high yield savings accounts give you. Gives you a few, but the list is somewhat limited. Versus like if you could get the same return, if not greater, and in most cases you'll get a better return, more efficient bond, especially when you factor in taxes, and it's for sure more efficient than a high yield savings account long term, especially when you factor in taxes. So you have like long term check. If that's all we cared about, like you could end the discussion there. But the thing that gives you a better long term return when you factor in taxes is the safest alternative, gives you a death benefit, which the others don't, gives you chronic illness riders, has some predator protection. Like you start adding this up and you're like, man, if someone would think long term and understand the value of a foundation, it's like, why wouldn't someone do this? Especially with like your belief around an emergency fund. It's not like you get to a place where you don't need an emergency fund anymore. And if there's anything, the more your family grows and the bigger the house you get, the bigger your emergency fund should be.
No, I totally agree, and that's that kind of gets into it, right? It's like some people will say, well, like you can get higher returns with better tax treatment by investing in municipal bonds, and I'm like, yeah, you could do that, but if you have a whole life policy, whole life policies offer a municipal bond tax treatment with corporate bond yields, so it's even more on top of that. The creditor protection piece is really interesting because prior to starting this journey, last year I was evaluating, do I need to up my umbrella insurance to the next liability clip, right? And then I was talking to our estate attorney, and he was explaining how with the whole life policies in the state of North Carolina, our cash value is protected from liability. So I actually don't need to go to the next, I don't have to pay for additional umbrella insurance yet until our taxable brokerage accounts reach a certain threshold because the state of North Carolina protects whole life policies. So imagine all of that staying in a bond portfolio or a cash. Like I would have to pay more money in insurance by having umbrella coverage, so it's tough, man. I mean, like our generation we don't want to think in complexities, and I get it. Like typically the more complex something is, like it's probably there's probably some drag built into that.
Yeah.
But like with financial planning, you know, it's kind of the whole like more money, more problems. I get it. It's like but you can't play this game in a binary fashion. Like it's not just yes or no, black, white, you know, 0, 1. It's like there's layers of complexity that you need to think about.
Yeah.
But it takes it takes mental effort to do that. And I think it's much easier just to flip on a Netflix show and, you know, watch that versus like flipping on a 30-minute overview of how a whole life, like it takes mental energy. I get it. Like people want to be done with school when they're done with college, but I also think that's kind of a death sentence in a way.
Yeah. I'm with you.
In a lot of ways.
I'm with you. Kyle, is there anything else that I appreciate your perspective that you shared with your kids. It's not traditional, I will say, to start on your kids and then do your policy on yourself. And we could unpack why, if someone asked me, like I would say people's first dollars should be on themselves, mainly because of the waterfall effect of like, yes, the kids policy over time will get a greater IRR, most likely, but you're going to die before them if statistics, you know, on a large scale of numbers. And so one of those things where, you know, I've said in the past, I've not done this for the record, but it's like if I could get a policy on my dad after I max out my insurability, that would be an interesting play because I can control that cash.
Yep,
His likelihood of dying before me is a pie. Yep. You know what I'm saying? And there's an aspect of that. It would be less efficient than if I owned it on myself from a cash value standpoint or my kid, but it's like you're thinking with a guaranteed date. So it's just interesting thoughts. Yep. Anything else in this journey that you've learned or any questions you have for me? Because like I know this is the first time we're talking, and I just also want to say if you're watching our channel and you feel like you have something to share or you disagree with something that I say, or like we want to have dialogue. Like that's one thing that we try to do is we want to talk to people even if they disagree with us because nothing is off limits.
Yeah, well, the debates that you guys do are fantastic. I find those very enlightening. Yeah, I haven't thought much about like why we chose the kids versus ourselves. I think our financial plan is so dialed in now, and this is like it's a kind of a pet peeve of mine with like friends and stuff that I talk to. I think what people really need to understand is like we're talking about building out whole life policies, you know, where we're putting cash, making sound decisions with your money. People, number one, need to have like a very solid savings habit for any of this to work. I think sometimes folks are like, okay, this is going to be my magic ticket, and I'm like, no, your savings, your ability to grow your income, and your savings habit, your ability to keep more of that income 100%. That you grew into. I think when I first heard about whole life policies through Infinite Banking in 2016, my salary was 6 times less than what it is today. Wow. There's a big lesson in that, right? Like it's like you start to master your craft and what you do. Employers reward you for the ability to execute and what you bring to the table. That opens up a ton of options. I would say in 2016, if I understood what I needed to about whole life, I probably still wouldn't have chosen whole life because I would have been choosing between a Roth IRA or a whole life and not really, like I wouldn't have had enough extra cash flow to decide which one got most of that or all of that or how to split it. So, mastering your craft and like growing your income is really important because it opens up the optionality of like, now I don't have to pick between our Roth IRAs and whole life. I get to do both. I get to choose to overfund all these places, but that's because we have a really good savings habit. We live below our means. We're very disciplined in what we do. So I think part of the reason why we chose our kids is because our financial plan was so dialed in that I wasn't really thinking about what to do with emergency funds because they're emergency funds. It's like, just leave them alone. Don't touch them. The goal is not to touch them. And so it was like, well, let's figure out what we want to do for the kids. Like, let's set up a UTMA for them. Maybe we'll do a 529. Maybe we won't. Not sure. Let's do this whole life policy because then that allows me to give something to my grandchildren. That actually was probably the big crux of it was how can I do something for my daughter, but also her potential children. It's a way to kill 2 birds with 1 stone.
Yeah, that's cool. It's great. It's a great analogy.
I can't do that with me, right? Like if I take out a whole life policy for me, I can only designate one beneficiary, which will probably be my kids. So I'm just
Yeah.
kind of in a weird way giving to them
With proper
anyways.
trust strategies, you can do anything,
Yep.
but you're totally right. You're putting a policy on your kid. And by the way, I have a daughter as well. She has a life insurance policy on her, so I'm a big fan of policies on kids. And
Yep.
I never even thought that that one decision is also helping my daughter's future kids. It's pretty cool
Yep.
to think about. It's like it's like no duh. Anything that we do long term should bet, but it's like no, like that one decision has implications for a generation, and as a result, will also affect the next generation, whether I get to see that transpire or not. And that's pretty cool to think through.
Yep. It's well, and it's other things too. I mean, like let's say that your daughter. This is not ever going to be our intention, but let's say that our daughter doesn't grow in her life journey the way that she probably should, and maybe she doesn't have kids. I can set a beneficiary on her whole life policy such that even if her life wasn't of much value giving back to society, she can still give back to society through her death. I know that sounds very morbid, but it's a way of like being able to add value to either that next generation after them, or maybe she's 16 and I don't know, something happens, she gets a life-threatening illness, but there was a nonprofit she was very passionate about. I can set them as the beneficiary, right?
Yep.
Like, how much wealth is a 16-year-old going to accumulate? Not much, but if their parents had a whole life policy on them, like it's just. Yep. It's that to me is the time travel component of it. It's why it was multidimensional. And I think through seeing their policies perform and execute and grow, it opened up my perspective for how that could fit into my financial plan, which was super dialed. Like, you weren't getting into that plan. Like, you had to fight and compete to get into our financial plan. And seeing her policy perform opened up my eyes to like, okay, maybe I don't need to not touch my emergency fund. Maybe I just need to shift it into a better vehicle. So, yeah, man, it just, like our belief system is if we can leave an inheritance to our children's children, obviously there's going to be a lot of teaching and life and character and setting an example for them along the way on how to, be people who are more givers than takers. So, I mean, that's why whenever I reached out via email, like I have taken so much from your channel. I'm like, I don't want to just be a taker of the content you're putting out. Like, if there's anything I can ever do to add value, let me know. If that's just, sharing a story or making a connection in my cybersecurity weird nerd tech world, like I'm happy to make the connection. I don't just want to be a consumer of somebody else's content.
Yeah, now you have a video to send them. So we appreciate you, Kyle. And again, thank you. Is there any questions that you have for me? I think the way that you laid things out was great, and I'm actually taking away some things from a standpoint of that concept of multiple generations and just making sure I'm more intentional when I share strategies with certain people, that there's ripple effects.
Yeah, there is one. I think the one thing, and I don't know where we're kind of going next in our journey, is from an estate planning standpoint. Is Garrett talks a lot about obviously having your whole life policy. That's kind of the financial aspect. You got your family constitution. A lot that's on me, right? But the estate planning standpoint is like where you're really starting to build that family office. I think the insurance agent aspect of it, they get it, but sometimes it's harder finding like legal firms and lawyers who understand CPAs and financial advisors who can all work together to understand this plan. It'd be very interesting, and it's probably not a question you can answer here, but that might be a future podcast idea of like maybe it's with Garrett, maybe it's with Garrett and his family office talking through like, okay, what are you looking for in an attorney, an estate planning attorney? What are you looking for in a CPA? How did you get them on the same page? How did you communicate this idea of a multi-generational irrevocable trust? That's kind of the next foray for us is finding our family office. I think we've got 2 of the 4 components of that. We got to find the other 2.
Yeah, love that. No, that great content idea. And if you we're to know what I'm working on right now with Better Wealth, we're trying to create solutions for that, like fractional family office for the person that can't afford to work with a real family office. But it's like all those components in. I think when it comes to the estate planning, it depends on how advanced you want to get. That's how, like, there are people on our network that can go really deep, but it has to make sense financially.
Yep.
And in some cases, it's like, how do we take traditional financial planning mechanisms and figure out a way to tweak, you know, from a standpoint of like, we're not going to do an irrevocable living trust right now because maybe estate planning is today, but we still want to make sure that our family has multiple generations. Is there something that we can do? Can we design certain questions into a revocable living trust and still get our cake and eat it too? And the answer is yes. It just, obviously, the more money that you have, the more creative you can get with figuring out that. And so I think that's a great question, and I definitely, it opens up for future content opportunities.
Yeah, I love that. I would love to hear, as you guys build that out, I'd love to hear more about that, because that's kind of our next foray.
Cool.
So I'm learning. I'm a sponge, soaking it up. I can nerd out about this type of stuff and love connecting with folks who are constantly thinking about it. So yeah, no, it's a good conversation. Glad you guys open up the opportunity for me to share and add value back to Better Wealth.
Well, Kyle, thank you. Again, if you have any questions in the comments, or if you're someone that wants to come on our show, please let us know. Kyle, thank you again for sharing what you're sharing. Appreciate you just being such a giver, and also consuming our content. Also, if you want to help us grow, you can share our content, like, and comment. That's a way for you to help, and you don't have to necessarily be on the channel. So if you're watching this and you're like, hey, I want to give back, that is a way to give back in a really profound way. So Kyle, thank you.
I only went for a day, and that was my biggest regret, because it was a phenomenal day. People start to see something in themselves they haven't seen before.
We are so excited to meet you all. We know that we are going to have a phenomenal opportunity to share all of our secrets.
We're open books, and we can't wait to share that information with you.